Hi, everyone, and very good evening, and welcome to you for this session. We are living in a very interesting time, and we have seen equity markets going through a lot of volatility over the last 6 odd months. But today we are here to discuss something which is very, very unique and different. Of course, we'll talk about the markets, why it is a good time, we believe, to invest in equities. But along with that, we're going to discuss about some very interesting and new investment themes which are very relevant for India over the next decade or so. And with that, we already have a launched new fund launch, which is Edelweiss Focused Equity Fund, and how these new investing themes of India are embedded and tied up into this fund is something which we're going to discuss today. And to have this discussion, we have our very own Trideep Bhattacharya, our equity CIO. He's there with us today. So welcome, Trideep.
Good evening, Niranjan, and good to hear from you.
Thanks, Trideep. So Trideep, let's get going. Let me first ask you a very, very straightforward question. How do you see markets today? And I believe, with a lot of indicators pointing that, and you have been pointing out that it's a very good time to invest in equity. Why do you think so?
So I think before we get to where we are today, I think it's probably kind of important to see the current time in the context of how we think about markets. I think since for the viewers who have been following us, they would probably know right from the year end or the year beginning, shall we say, we talked about the period from Jan 22 to March 23, this 15-month time frame to be a tale of two halves. And we always thought that the first half is going to be volatile. The second half is volatile stroke consolidation, stroke investment time. And second half is when the action starts. And the reason why we expected the first half to be volatile where the change in interest rate regime from falling interest rate to rising interest rates, inflation-related issues, transient it may be, but it hurts when it comes about. And third, geopolitical issues given the Russia-Ukraine war. So that's where we have been at for the last 6-9 months, and we've seen a good bit of volatility coming through, sometimes testing our patience as well. The good news is that we seem to be in the final couple of months of this 6 to 9 month period, wherein a couple of things are changing on the horizon. First of all, we are seeing that some of the industrial commodities like steel, copper, agri-based commodities are finally taking a nosedive downwards. So much so that over the last month or so, we have seen these prices correct anywhere between 10 to 25%, which is quite meaningful. Secondly, we are also hearing from chip manufacturers and that ultimately the chip manufacturing shortage that was there in practice for the better part of last year is finally getting resolved. And the third thing I would say that with China opening up, the logistics part, which were kind of quite difficult to handle over the last 6-9 months, is finally gradually kind of normalizing. So we think on the back of this, where we are today is at the ebb of inflation, where inflation from the next 2 to 3 month perspective might actually be trending downwards. As that happens, usually inflation was the lead indicator to why the interest rate outlook in the United States, in India, and various parts of the globe actually changed. So with inflation ebbing, I would suspect that some of the overarching worries with regards to interest rate hikes and whatnot will gradually mellow down. And that usually would mean good from an equity market standpoint. All in all, if I were to summarize the near term, I would say that it seems to me, from whatever data points I look at, that 75 to 80% of the bad news is there or thereabouts in the price. The last 15-20% is always difficult to time. Something always changes, and we've seen that timing the market is extremely difficult to do. And hence we think that if you look at the last year in context, this is a reasonable good time to look at, put some money to work. And that's why even though we have had this approval for this focus fund in our kind of arsenal for good 7, 8, 9 months, we thought that since we were cautious from the beginning of this year and we were only talking about STP, we sort of shelved or we moved away from launching the fund then. But now we think that with about 75 to 80% of the bad news there or thereabouts in the price, and it looks like that in the next couple of months, inflation might actually ebb, we think it's a good time to launch the fund. So that's where we are from a near-term standpoint. Now, you might ask as a corollary to this that, fine, it might be a good time to launch, but why should we look at Indian equities from a 3-year perspective? And I would say that from that perspective, when I look at a few things happening in Indian economy, it makes me constructive. Those are, for instance, there's a good chance of a private sector driven capex cycle to really come through in India. And we are positive across our portfolios on the same, but we feel it's a genuine good from a manufacturing part of the economy. Second, we see the salary, we're seeing salary hikes are finally coming through. Earlier for the last decade or so, we have been used to a situation of single-digit salary hike. We are finally seeing double-digit salary hike, which means even though the consumer is burdened with inflation in the short term, but if you give it 9 to 12 months, consumption spending might also come back. And finally, real estate sector is in the process of bottoming out. So all in all, I think that from a 2 to 3 year perspective, the equity view looks constructive. And in that context, if I look at the current investment opportunity, it looks attractive to me. So that's in a nutshell what our equity market outlook is. And as a conclusion of that, we are constructive with regards to money-making ideas right now, and hence we are launching this fund. It's only ironic that even as we were doing this roadshow, Niranjan, the markets have rallied close to 8%, but we still have more room to go.
Yes, absolutely, Trideep. And my next question is basically, while we are launching this focused equity fund, why do you think focused as a strategy work?
I think that's a great
especially
question.
in the Indian context and globally how it has worked. If you can just
I think it's a great question. And I think one of the studies that I saw some time ago, and it has stayed with me, has been a study done by a financial scientist by the name of Mr. Besim Binder. This gentleman looked at almost 100 years of returns in the United States from 1926 to 2018 in order to understand that how many stocks or what percentage stocks explain the stock market returns. And what he came out with was absolutely fascinating. What he found is that the 4% of the stocks, just about 4% of the stocks, explain 100% of the US stock market returns from 1926 to 2018. Now, 1926 to 2018 is close to a 100-year time frame. During this time frame, we've had booms, we've had busts, and as Ruskin Bond would say, we had good times and we had bad times and others. So in all of these put together, what remains is just about stock-specific alpha. And 4% explaining 100% of the market return, and the rest 96% matching just about the T-bill return, shows the extent of positive skewness that lies in even developed markets like that of the United States. Now, while we don't get 100-year data in India, when we looked at 20-25-year data in India, we saw a similar kind of a skewness come through. To cut the long story short, focused investing not only works globally, but works in India as well. And on top of that, if you look at my career spanning over the last 25 years or so, for a better part of my career, I've been used to running focused strategies. And hence, this sort of a strategy makes a lot of sense to me. And we think that if we aspire to be an alpha manager, then certainly we should find a focus strategy as part of customers or investors' asset allocation, which is geared towards alpha, being a focused fund overall. So focused fund investing certainly works. It's a good style from an alpha creation standpoint, and that's the attempt in launching the focused fund overall from Edelweiss table.
Right. Thanks, Trideep. And now I think so. The more important question is how will you find that 4% or 5% stocks in our or in your focused equity fund that you will be managing. So if you can elaborate on that, and most importantly, what are the interesting themes which you believe will work in India over the next decade or so, and how will you capture them in this fund and its unique strategy?
So in a nutshell, what you are asking me is how is our Edelweiss Focused Fund different from
Absolutely.
or from the competition? And I
Absolutely.
think in order to elaborate what I'm going to talk about, and this is probably the most important part of the presentation, I would refer to some slides. And as I look to share these slides, please give me a high five when you see the slides coming about. Uh, can you see that?
Yes, Trideep, we can see them.
Okay, fantastic. So let me now kind of elaborate on where we are on this. I would say that about 7-8 months ago, when we kind of yourself, myself, and a few others, and we sat together and racked our brain as to what has been the fund launches in the market. What we noted is that majority of the fund launches have been like business cycle fund, economic recovery fund, rural recovery fund, thematic funds, all nice ones, but they are all looking to play the economic recovery ensuing in India over the next 2 to 3 years. So when I sort of looked at it from the same perspective, I thought that none, if any of these, are looking to play where Indian economy is in the stage of evolution in the global landscape. Now, what do I mean by that? So, if you look at 10 years ago, India was mostly in a roti kapra or makan economy, where basics were really the rule of the day. Today, we are a far more aspirational economy, where people want to aspire to look good, feel good. And maybe in 10, 15 years' time, we will get into a mature economy where people kind of, maybe go back to basics or want to kind of, see sustenance of life. Themes are sometimes are very relevant to where the economy is in the stage of evolution. And hence we thought one of the ways that we could differentiate versus that of competition would be to look at themes where we are themes which are very relevant to India in the current stage of evolution. And as we thought through, we couldn't find three better themes to allocate than the three that you have in front of you: brands, market share gainers, and innovators. So overall, when I look through these themes, let me kind of take you through briefly what do these themes stand for, and hopefully that gives you the comfort that your money will be invested in the right spot. Brands. I would say that India's time for brands has come. Over the next 10 to 15 years, as the India's per capita GDP moves from $2,000 to $4,000, one of the things that we have observed in an economy going through such a transition is that the brand adoption in the economy goes up significantly. This not only is happening in India and will. This happened in Korea, Taiwan in 1990s when brands like the Samsung, Hyundai, Kia came about and later on went on to become global brands. This happened in the United States in 1970s where we had brands like Walmart, like McDonald's, etc. come about. And I think we are at the moment in India, right at the cusp of beginning of this stage, where some of the companies will go on to become reasonably good brands over the next 10, 15 years. We are not making the claim that they will be global brands, but we think that ultimately this process of brand creation over the next 10, 15 years is a very fruitful place to be for investors from a wealth creation standpoint. And what we will look to play in our portfolio would be a bunch of two types of brands, as you can see in the slide in front of you. One is what we call emerging brands, brands earlier in their life cycle, which are looking to go bigger over a period of time. Second, established brands, brands which are kind of national brands, there or thereabouts, but they still have a huge runway of growth in front of them. We think that while emerging brands have a story of earnings growth as well as PE re-rating, established brands bring an aura of stability in the portfolio. But that's the first theme for you. The second theme, ladies and gentlemen, is basically market share gainers. Now, why did we choose market share gains? Over the last 5 years, one of the strong things that happened in India was basically reforms. There's not been a single sector which has been left alone from the reforms. Whether it was demonetization, GST, sugar sector, chemical sector, everywhere there's been reforms galore. One of the common implications of reforms is that the gain of organized market at the expense of unorganized market. And what we are looking to play in the name of market share gainers is basically those companies, particularly in the cyclical end of the market, which are like as part of the organized market, which would stand to gain at the expense of unorganized market. We think that over the next 10, 15 years, some of these market share gainers would consolidate and turn out to be strong industry leaders. And this process could be extremely profitable for investors to capitalize on. Market share gainers ultimately leads to superior growth than that of the sector, which given the operating leverage means a non-linearity in earnings growth. And that is what we are looking to capture. So two types of market share gainers. One who get the message and who's been consistently gaining the market share. These are usually sectors with a lot of tailwind in front of them and maybe a lot of unorganized market as well. But at the same time, there are some emerging market share gainers. We start gaining market share driven by a catalyst, which could be a management change, focus in a new segment of the market, or maybe kind of the strategy change and getting the right to win. So that's our second theme that we are looking to kind of play off. The third, I would say, is what we call innovation. Now, innovation, if you ask me, is as much a global theme as much as it is a local theme. But in the context of the last 100 years, we probably live in the world of a disruption, where probably every area that we kind of participate in our life is seeing some or other disruption. And there are really four ways to play this disruption, as you can see in this slide. We could either be an innovator. These are the guys who take the technology risk, the R&D risk, and to be honest, have a risk of substitution. As one innovator may succeed, or second innovator may succeed. We don't know. Or we could be, nobody wants to be, but we could be in a disrupted business, the business which gets impacted by the same. Both of these areas are actually high risk and high return areas. If you get it right, then you can make a 200 bagger. But if you get it wrong, we could really kind of be here and see severe capital loss. But there are two boxes, as you can see in this slide, which in our opinion are the sweet spot if you want to play innovation as a theme. They are enablers and adapters. Enablers are the guys who supply nut bolts to make the innovation happen. A bit like an Indian IT services companies in the context of global digital adoption, or an auto ancillary company in the context of EV disruption that we are seeing across the globe. Adapters are actually competitors of innovators, which is the second way to play this theme. These guys are not the first mover, but they are fit to adapt. And as they do that, in this process, they kind of capture better part of the sweet spot of market share gain or subscriber gain, or overall in some form or the other, a better way to capture the profitability and return ratio. So in other words, our thinking in the context of innovation is to be in the relative sweet spots of enablers and adapters, which will help us make money overall on a risk-adjusted basis. So just to summarize what we are talking about, we are ultimately talking about a focused fund where the strategy is going to be own 25 to 30 names overall. We understand that 25 to 30 names means a more concentrated portfolio and hence probably slightly higher risk. Hence, we are encouraging investors to come into this fund with a 5-year outlook or more. Second, we think that while there is a merit in having many other funds in their asset allocation, this part of the portfolio should be oriented towards that part where we think alpha. Second, we think that overall, in order to mitigate the risk that the concentrated portfolio entails, we are talking about 3 themes, which hopefully gives investors the comfort that their money is invested in areas which have long tailwind. These are brands, market share gainers, and innovators, where we think that, even if there is a volatility in the near term, they will come out in flying colors over the medium term. And finally, we think that with 75 to 80% of the bad news is there or thereabouts in the price. And, ahead of elections in 2024, certainly we think that the economy is looking like in a decent shape. This is a good time as any to sort of think about investing in our latest focus fund offering that's at the moment ensuing. So with that, I would stop here, Niranjan, and back to you.
Thanks, Trideep, and I think so very well explained. I have a couple of questions, and we are getting a lot of questions also from the audience. One question to start with is, so while you explained, brands, market share gainers, and innovators, what is the reason of having all these three themes, or maybe only these three themes in the fund? Is there any linkage between the two? Or does these covers various economic cycles, or what is the reason to have only these three themes?
Actually, as I explained earlier, the answer is probably a corollary of that. As I explained earlier, that these themes were chosen keeping in mind India's evolution in the global landscape. So today, with the aspirational nature of the Indian economy, of Indian consumers and Indian businesses, brands naturally come out of that. So likewise, with the reforms that we have seen under Modi government over the last 5 to 10 years, market share gainers, gain of organized sector at the expense of unorganized sector, in my opinion, over the next 10 years is a no-brainer. And finally, with all of us holding back in our homes over the last 2 years, courtesy COVID, we have seen the peak of disruption. So, that's another thing which is relevant not just in India today, but globally. So if you ask me, these are the three themes which actually jump out themselves, given the situation that we are facing, in my opinion, most relevant in the context of India's evolution. And at the same time, they have a long-dated shelf life, which is the most important part. So that's why we chose these three themes, not more, not less.
Right. Just a follow-up question to that. I've got another question, which asks, is there a specific allocation percentage which you have decided between these three themes? So is it going to be a top-down kind of approach in terms of weighing, percentage into each of these three themes, or it is an outcome of your bottom-up analysis?
See, at the end of the day, we at Edelweiss MF are bottom-up stock pickers. We use macro, i.e. interest rate, inflation, this, that, more as kind of a lighthouse to see where we are. But ultimately, we are bottom-up stock pickers. So, ultimately, the proportion of stocks that will fit into each of these three themes will be a function of the number of stocks that we can make it match, not just into the themes, but also as a stock in terms of upside, margin of safety, and likewise. Remember, this is not a thematic fund. What we are looking to do ultimately is a buy stock to create wealth for investors. Just because the stock fits into the theme doesn't mean it will find a place in the portfolio. It has to make sense as a stock with regards to valuations, with regards to earnings, and the usual stuff for us to kind of own that in our portfolio. So hence, different stages of the economic cycle, different types of stocks become cheap. For instance, brands, if I were to call it, about close to a year ago, were so expensive, were very difficult to touch from a fundamental standpoint. But with Indian markets having seen a derating of close to 25% from the first 6 to 9 months of this year, we think now some of the brands are more reasonable in terms of valuations. Likewise, with regards to other themes as well. And hence we think that setting up a percentage in each of these would actually kind of limit the flexibility of the category, and that is not what we want to do. Also, to be candid, there could be a bit of overlap across these three categories. So hence, all in all, to cut the long story short and in a nutshell, we haven't put percentages.
One question now, it's a very interesting question, is on the large cap active side, a lot of funds have been struggling to beat the benchmark. How do you see focused as a category while you explain it's a multi-cap or a flexi-cap kind of mandate, how do you see the alpha generating opportunity in this space? And specifically the themes which you would be, investing into?
So I would probably say that ultimately, to a certain extent, the alpha generation capability or the probability of alpha generation increases the lesser the constraint you have. So if the constraint is to invest only in large cap stocks, then certainly the alpha generation capability is constrained by that. But by the fact that we are ultimately talking about this focus fund would be run in a flexi cap way, we have the opportunity to choose the best amongst the large cap, mid caps, and the small caps. And hence, we hopefully can get the best of all the worlds. That's one. Secondly, if I were to look at in terms of guardrails versus many other categories that are there, given the SEBI categorization with regards to what percentage of stocks need to be in which category, that brings another level of constraint, which is not applicable in the case of focus fund as a category. So that gives a regional and era or a latitude of flexibility, which we can use to our benefit in generating alpha. And third, sometimes with more diversified funds, we do diversification for the sake of diversification. Here, with about 25 to 30 names, hopefully we can focus on or concentrate our bets on whatever we think are the highest conviction bets. And hence our chances of alpha is better here than other places. So those would be the three areas that I would point out why this one, this category, focus fund as a category, works certainly against the large cap as a category and maybe a few others.
Right. So the another question is, Trideep, which, while you have explained it and elaborated in much more detail, the question is how this fund would be different from the existing focused fund or diversified fund. So whether the names of stocks which you will be holding would be very different, or the weighings will be different, whether it is sector. So how will it be different at the portfolio level, if you were to explain it in more detail?
So I would probably say that, just to repeat what I said, that ultimately the themes that we talked about earlier, which is brands, market share gainers, and innovation, they should give the investors the comfort that even if it is a focus fund, we are invested in long-dated securities where we have a long tailwind. We are not looking to. It's not a trading strategy. It's more closer to buy and hold than a trading strategy. Let's put it this way. So that's one. Second, overall, while our attempt would be to find stocks which are or nuggets or niches where we kind of where we cater to or where we differentiate in terms of stocks versus that of competition, the focus really is not that. The focus is wealth creation, and the wealth creation would be a mix of two things. One is maybe there will be some stocks which is common as that of the rest, but they would be money making ideas. But there will be others which kind of suit to the themes that we talked about, which can be materially different from that of competition. But all in all, the idea is to generate alpha over a period of time rather than sometimes differentiate for the sake of differentiation. So while there will be some differentiation, we are differentiating in the form of themes that we are looking at, that's kind of an additional areas of focus. But I do want to make a mention to investors that over differentiation for the sake of it leads to no alpha, and sometimes can be to our detriment. So sometimes being in consensus also makes sense, provided that the stocks do well. So it'll be a mix and match of both is the answer to the question. And then hopefully we'll talk in 6 months' time.
Right, Pradeep. The next question is, the innovation or the disruption theme is very promising and it's quite unique to the strategy. The question is, so which sectors do you think over the next few years will get into disruption, and without naming stocks, of course, which are some of the businesses which would be the enablers or maybe adapters of these kind of disruption?
If the gentleman who asked the question were in front of me, I would ask him, and I would use you as a proxy to that tell me one sector which is not undergoing disruption right now.
Absolutely.
I would say from the way we consume energy, to the way are looking to travel from point A to point B, to the way we consume, to way we think, we sleep, and how we read. Everything is going through a bit of disruption overall. If you don't believe this, I would give a simple example. And there's no compliance issue because I'll give an example of US market. Then in the United States, online retail, it took about 25 years to go mainstream, i.e. from 0% to becoming 15% of total retail sales. And in the next 25 months, it went from 15 to 30. So it became from 15% of total sales to 30% in just about 25 months. So 25 years and 25 months. That is the pace of this disruption, ladies and gentlemen, that we are facing right now. So in this time, there is hardly any sector which is staying away from disruption. Hence, we better be mindful and own some stocks in our portfolio where, which benefit from this disruption. Now, in simple language, there are two ways to invest. Either you could invest in a hairstyle, or you could invest in a barber. Investment in the case of a hairstyle would mean whether the hairstyle, your hairstyle works or mine, we never know, right? You may turn out to be the more popular guy. But if I am a barber, then I get business either way. So that's what I mean by owning an enabler. So the enabler is the barber, who maybe in the context of sectors would be in the context of digital adoption. It will be an IT services company in India, where it doesn't care, or may have clients which is JP Morgan, Citi, and all the banks as their customer, who are looking to kind of be in the forefront of digital adoption. And if company A succeeds or B succeeds, because both of them are their clients, as opposed to, let us say you were to invest in one of those banks, and let's say that bank strategy doesn't work, then you are run the risk of capital loss. So that's why, while I don't, again, more than this, if I speak, I'll end up giving stock examples which I don't want to, and I'm using global sort of names to avoid getting into compliance chaos. But hopefully this example tells us how we are looking to play the innovation as a theme. Niranjan?
Right, thanks, Trideep. The next question is actually on the deployment of funds, because since it's an NFO which will end on 26th, and you'll get money. So how will you deploy? So as per SEBI regulation, of course, within 30 days, you will have to deploy. So will you take or utilize that 30 days given the markets are volatile, or it'll be deployed in immediately 1 or 2, 3 days is the actual question.
No, I think the overarching principle that we at Edelweiss MF follow for all our funds is that we don't take cash calls. I think that investors should keep in mind, particularly when they're investing in long-only funds, which I represent. And within that, I would say the SEBI rule, as you highlighted, is that the fund should be invested, within the one month, and that doesn't leave too much of time for timing the market really. So basically, to cut the long short of it, by 1st of September, we'll be fully invested.
Right. The another question is, you mentioned, Trideep, that it will be a sector agnostic or a benchmark agnostic fund. So will there be, a lot of skewness in terms of sectoral weights as compared to benchmark? If yes, how much of that would be, or what could be the expected numbers?
So that's another part of our operating principle, which is that across all the funds that I run, which is large and mid, flexi cap, mid cap, small cap. One of the operating principles that we have set out right in the beginning is that we don't take huge sector bets, and that will probably continue to hold even in this context as well. What I mean by that is index plus minus 5% is the guardrail within which we operate. And broadly speaking, that's how we would kind of, look to operate even in this case to the extent that is possible. Sometimes under extraordinary circumstances, we will kind of be on the other side, but that will be an exception than a rule. So we will not be skewed towards one or two sectors, but generally, if you look at the themes that we are talking about here, maybe PSUs or regulated utilities, these would be two areas where we probably be structurally underweight. Never say never, even utilities can see disruption. We will see how that goes. But prima facie, those would be the areas which will probably find less fancy in the context of the themes that we talked about.
Got it. Thanks, Trideep. I think so. We've answered most of the questions. Okay, we have one last question over here. So will ESG aspect be taken into consideration while selecting companies? And maybe Trideep, you can explain our investment philosophy also in nutshell, which we follow across all our equity funds and even in this fund. So that will, probably answer this question as well.
Yeah, Niranjan, I would say that that is a fair question. And if I were to, I was anyway going to make the excuse of this question to evaluate, to talk about the investment philosophy, because it's important for the listeners and the viewers that they know the character of the AMC or the MF that they're dealing with before they invest. And I would say there are 4 cardinal principles around which our investment philosophy is centered around. First, forensics. Second, acceptable price. Third, ESG informed. And fourth, robustness. Now, while these may look like disjoint pillars to all of you, if I were to join all of them, I would say that we are interested in financially clean companies that can grow sustainably. We are interested in robust business models that are presenting growth opportunities, but can scale that in profitably with higher return ratios. And finally, they should be available to us at an acceptable price. Now, this, if you look at it, the forensics part covers the financial cleanliness. And we are fairly kind of stringent across on this parameter, so much so that there have been instances where the companies which have fundamental score very high, but forensic score low, we have actually kind of, shunned away from them and have actually seen the benefit of the same as well. So that's the financial cleanliness part of it. The second part of it is the question that you asked, that ESG will be being part of the strategy. I would say that we are ESG informed. So while forensics is a screening tool for us, ESG is more an information tool for us. We want to be aware of where the company places itself in the context of the sector, and whether it is Q1, Q2, and stuff like that, to understand, how they are kind of looking towards the better good of the economy. But folks, ultimately, we are here to make money. So even if the company is on the lower side, we'll probably engage with them to sort of, get the rankings up. But if it's an alpha making opportunity, we will go ahead and invest in that company. For instance, we follow this ESG informed strategy in our existing portfolios, and ITC is one of the holdings that we have. And that, I guess, is a factual information, so it shouldn't be a problem. The other thing that I would highlight is our valuation consciousness. Just because we are talking about the themes doesn't mean that we'll pick and choose the most expensive stocks that are there in the market. All the stocks that we invest in our existing funds and also in the upcoming fund should and will have a starting upside of 20% or more. This is what we call the acceptable price part of our framework, and we follow that fairly religiously across all the stocks that we own. And finally, we want to stand for those companies which not only bring on growth, but also are profitable and have higher return ratios. So loss-making companies which have long-dated cash flows that will come sometime in future, and at the moment it looks more like hope than otherwise, would probably not find fancy in our existing portfolios, and likewise in focus funds. So that, in a nutshell, ladies and gentlemen, is the strategy that or investment philosophy that we follow. And as I said, we put all of these together: forensics, acceptable price, ESG informed, and robustness, and we call it a fair framework. So hopefully, Niranjan, with your fair question, I've given you a fair answer.
Right. Thanks, Trideep. There's one question on whether we will be investing in foreign stocks. So let me answer that. So while currently, because of the limits of investing in overseas securities is being closed or reached at the industry level, right now we won't be investing in foreign securities, but as and when the limits open, the fund will have that flexibility where we can add that to the mandate and we can own some of these stocks in these three themes, which are, outside India. So with this, Trideep, I think so. If you want to just sum up in maybe a nutshell about the market and about the fund in maybe 2-3 points, and then we can close.
Yeah. So if I were to sum up all that we said in 45 minutes, then I wonder why did we spend 45 minutes? But if I were to spend in a couple of sentences in what we say, I would say we answered 3 questions really. Why now? We think with 75 to 80% of the bad news is there or thereabouts. We're in the final round of bad news, and this is a good time as any to look at a new fund in the form of lump sum. We think focused as an investing style works. There is enough and more evidence globally and in India. We talked about in length about one of the studies. And finally, we think that in the form of Edelweiss Focused Fund, we have a differentiated offering where we think we can make a difference from a money-making standpoint by focusing on 3 themes: brands, market share gainers, and innovation, which we think are, if you put together a bunch of 25 to 30 names which cater to these, and people come in with about 5-year outlook, we have a very high chance that we'll generate good amount of alpha for them. And with that, good luck to you in the final round for the NFO, to all of us, and happy decision making, I would say.
Right. Thank you, Trideep. And, we end our session here. Thank you all of you for your participation, for all your questions. We may have missed some questions, so do reach out to us on our social media channels or our help desk. Email us all your queries. We'll be more than happy to answer them, and look forward to your participation in this fund and all our existing funds, which, Trideep manages and his team manages so very well for all of us. Thank you, Trideep, and thank you all of you. Have a great day and maybe a great weekend after tomorrow. So thank you so much.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.